Many equities and bonds have had a difficult first few months of 2022. And one of the things that's worrying investors most is tighter monetary policy. The U.S. bond market is currently pricing in one of history's largest rate increases over the next 2 years. At Citi Global Wealth Investments, we doubt that the Fed will actually tighten as much as that. Instead, we expect market interest rates to peak at some time in 2022. And even if the Fed did tighten as much as it is suggesting, history also suggests it would then be cutting rates again just 6 months later or so. Amid all the uncertainty, we're hearing many investors ask the same question: isn't now a good time to hold cash? Despite the rise in interest rates, things haven't really changed much for the owners of cash. After adjusting for inflation, cash interest rates in most leading economies remain deeply negative. In the US, consumer price inflation recently hit 8.5% and is expected to decelerate slowly. While readings may not stay this extreme, interest rates below the rate of inflation could be a fact of life for some time to come. The effects of this for the owners of cash is painful. We compare the process to the exploits of a cash thief who silently steals your purchasing power year after year. Far from offering safety, therefore, we warn that sitting on lots of cash risks leaving you much poorer over time. In our view, the cash thief's exploits call for prudent investors to take action. Our preferred approach is to seek out assets that may generate a positive real income for portfolios. In recent years, ultra-low yields on many bonds have left them as vulnerable as cash. A few months into 2022, however, and the situation now looks rather different. If you've been waiting for a rise in yields, we believe your wait is now over. And while inflation has risen more than almost any yield over the past year, we don't believe inflation will be 2 to 3 percentage points higher for every year going forward. That's how much various high-quality bond yields have increased in 2022. As well as now offering more attractive income, they also have the potential to diversify portfolios. Among those that we favor are U.S. investment-grade bonds, U.S. preferred securities, select emerging market U.S. dollar-denominated bonds. Our message for investors is clear. Your cash remains very much at risk from negative real interest rates. That said, however, we also see attractive options for putting cash to work and seeking yield in your portfolio. While some of these are within fixed income, other asset classes have a part to play. In equities, we favor allocating to dividend growers, companies with a solid history of growing shareholder payouts, and select natural resources investments. For qualified investors, we also see income potential in certain capital market strategies and private market strategies. Remember, seeking a positive real income can help defend your purchasing power. It's time to get portfolios fully invested and keep the cash thief at bay.